And more business news for you now. In the U.S., rising living costs are front and center in the minds of Americans as they head to vote in midterm elections. Earlier, I spoke to Bill Dudley. He's senior research scholar at Princeton University and the former president of the Federal Reserve Bank of New York. Now, in a CNA exclusive, he gives us his take on how tighter monetary policies are hurting America and the world. He's in Singapore for the inaugural Future of Finance Forum.
Tighter financial conditions result in exactly what you just mentioned: lower stock prices, higher credit spreads, higher bond yields, and a stronger currency. This is a necessary transmission mechanism of monetary policy to slow the economy down, to generate more slack in the labor market, to get inflation back down to 2%. So, yeah, I think it's going to be more painful, not just for corporate America, but also for U.S. households.
So employers have added some 261,000 jobs in October. That's a sign that the labor market remains robust. And yet we've had another household survey which shows an uptick in the jobless rate to 3.7%. What's your reading on the jobs market?
Well, I think the labor market is gradually cooling off, but it's still too strong. You look at the 261,000 increase in payroll employment. That's well above a level that's consistent with a stable unemployment rate over time. Look at the wage trend. Wages are trending around 5% a year. That's way too high to be consistent with 2% inflation. So the Federal Reserve is just starting to have an impact on the pace of economic growth, just starting to have an impact on the tightness of the labor market. It's going to take some time for the Fed to achieve its objective of getting inflation back down to 2%. So I think there's two things that what we have to focus on. Number one, short-term rates are going to be higher than where they are today, probably peaking at around 5% or a little bit higher. And two, the Fed's going to have to keep those rates at 5% for quite some time to actually achieve their objective of getting us back down to 2% inflation.
Now, bearing in mind that the U.S. economy is technically in a recession, do you think that the contraction this time around will be a mild one, or should we be bracing for a bigger shock?
Well, I don't think the economy has fallen into a recession yet. It's true that we had two negative quarters during the first half of the year, but they were barely negative, and they didn't have the broad-based weakness that would be consistent with recession. The third quarter, we had positive growth, and it looks like the fourth quarter, we're going to have positive growth as well. So no recession quite yet. That said, I do think a recession in the United States is virtually inevitable at this point. If you believe that the Fed has to push up the unemployment rate substantially, that just doesn't occur outside of U.S. recessions. Now, I don't think the recession, when it does arrive, is going to be particularly deep because household and corporate balance sheets are in quite good shape. So I'm expecting a recession sometime in 2023, but I don't expect it to be severe, not particularly deep.
What do you make of the longer-term challenges facing the world economy and how central banks should actually navigate them?
Well, I think one of the biggest challenges facing the global economy is the fact that we're reversing some of the trends to globalization that helped us in the 1970s, 80s, 90s, and 2000s. The trend towards globalization raised productivity around the world. It held down inflation. And now as we reverse that, the economy is going to not be as productive and it's going to be more inflation prone. So I think anything we can do to sort of arrest this fragmentation of the global economy would be a very positive development.
What can be done?
I don't think there's any easy answers. I mean, I think for the start, it'd be really great if China and U.S. relations could start improving again. That's really, really important. Obviously, what happens in terms of the Russian-Ukraine war is also important because that creates a lot of risk to energy and food prices. And lastly, we have to do a better job of trying to help low-income countries deal with very large sovereign debt burdens.